All right, everybody, real quick before we get into this, I'm working really hard to grow the Options Education Channel's YouTube page. So if you found this content valuable, I appreciate it if you would like and subscribe so that you don't miss content. All right, everybody, welcome back. Let's talk about volatility. So on the screen right now, we're looking at Campbell's Soup. And Campbell's Soup, as boring as it is, a company that you may have never ever even looked at the chart before, this is one of the greatest things that I've enjoyed trading for earnings. It has an amazing ramp cycle that I really want to get into today because it goes right into the heart of implied volatility and ways that we can use it in our trading. So what you can see right now on the screen is these earnings events. And if you'll notice, at every earnings event, we had the increase in volume, but we also had this really high peak in the implied volatility. The reason that I like this product so much is this ramp that happens. It's drawn out over a couple of months. You can see here we were in mid-March, and by the time it reported earnings in June, it had ramped up from around 23 to near 40%. Now we're going to get into why implied volatility at earnings is a second-tiered Greek. We will get there. But in this video, I just want to talk about option strategies that we can put on when we expect an increase in implied volatility and how it can really help us out in our trades. So a lot of people, they look for earnings because they want to play this volatility crush. It's a good play. I can't argue with it. Getting into an earnings trade, selling something like an iron condor, letting it report earnings, and taking that volatility crush, sucking all the life and the value out of your options, and then selling them, buying them back really cheap, I get it. That's a good play. One thing that I like that pays a lot more and holds, in my opinion, less risk is a calendar trade. A lot of people don't like the calendar trade because it doesn't have a defined risk that is set. When you put on a vertical, you know exactly what your risk is. The trade doesn't change shape. So you can put on a trade and it will keep that shape all the way to expiration, and you know exactly what you have. A calendar trade is not that way at all. And instead, it will actually expand like a balloon. And your max profit or your max loss grows and contracts with volatility. The reason that that is so important is way back here in March, for an example, I could decide to put on a calendar trade. Now, if you've never heard of the calendar or if you're unfamiliar with it, it's a lot like throwing darts at a dartboard. You pick a target, and when the day comes for those options to expire, the closer you are to that target, the more money you make. And that sounds really good. Your room to be wrong, the bullseye, so to speak, the more money you put into it, the bigger it is, so that you can be, quote, close and still make money. Now, if you get too far away from the bullseye, you start to lose money. And the farther away that you are, the more money you could lose. It's a very straightforward strategy, or I should say it's a straightforward trade. The strategy comes from the understanding that when implied volatility expands, so does the room to be wrong and still make money. So for an example, if back in March I decided to put on a calendar trade for around $40, the closer I get to $40, the more money I make. And I have a room to be wrong, and we'll say the room to be wrong is around, $1. So I can be $1 higher, I can be $1 lower, as long as I'm within that range, then I will be in a profitable trade. So we'll go one direction to 39, and we'll go another direction to 41, and we'll look at what that window would be. So with the implied volatility near its lows, if I was to put the trade on, aiming for $40, if it gets anywhere inside of these lines, I won't lose money, but I will make more money the closer we are to the green line. As the volatility expands, as the volatility increases, so does how far away I can be from that green line and still not be in a losing trade. So we did have that set at 39, but as volatility goes up, maybe it goes to 37, and instead of 41, maybe it goes to 43. So now my target is still the same, but I could be a lot farther away and still not be in a losing trade. And then by the time we get to earnings, very, very high up, about as high as we know that we're going to get, that trade could have expanded a full $5 in either direction. Now, it's hard to say how much it really will expand. We can project a little bit by looking at previous earnings and asking the question, how often has it expanded before and by how much? And we can add that up. So we can look at the last 5, for an example, and we could measure from low to high. This was 56% increase. We could do it another way with just a regular line. And we could say, okay, it went up 0.15. We could see that, right? 0.15%. That's not bad. That's a 15% increase in implied volatility. The next time it had earnings, 18. The next time, 17. So 15, 18, 17, and we could keep doing that. If we go backwards, we could keep doing that as many times as there was a ramp. If we did it 10 times and then we added all of those scores together and divided by 10, we would have an average. And we could apply that average. After we have the average, we could go in, build the trade, and put in that average. We'll just say it's an average of 15%. We could increase volatility by 15% and look at what our options trade does, how big the expected move gets, and that would tell us how much the trade could be wrong and still not lose. I love this trade, by the way. It's not as easy as it sounds because you have to pick a point on the chart somewhere in the future where you believe the price will be. Not somewhere along the way, but where you believe price will be when the trade is going to expire. So imagine whatever day it is today for you and thinking, where is price going to be in 2 months from now on that date 2 months in the future? Where is it going to be? How much are you willing to bet that you're right? How accurate you think you could be? And do you think that's a trade that you could win often? Well, Campbell's Soup is a good company. I love to put that trade on, and that's a calendar trade. It's an earnings trade, but it's an earnings trade with a calendar, and I really like it. What it doesn't do is wait for the earnings to report. You want to get out before it actually collapses the earnings back down again, the implied volatility. This volatility ramp is something that a lot of people overlook. They just get excited about the quote high volatility. And perhaps in this video we might not have enough time to cover the fact that this isn't necessarily high volatility at all. It is elevated compared to what it normally would be, but it's an earnings volatility. There's no edge to it. It's all been priced in. And worse than that, it's a second-tiered Greek. So normally, when implied volatility goes up, what it is suggesting is that the distance between close from the one candle to the next is increasing. And the more that it goes up, the more we expect to see that distance grow on the chart. It also means that the expected move gets bigger. So when we have a really low implied volatility, this cone that we see right now on the chart, that cone isn't very big. But when the implied volatility expands a lot, so does the cone. So does the range that we believe that the market can move. So this is something that people get overlooked, but as we come into earnings, the market makers don't want that expected move to change. They want it to hold still so that people can, quote, place their bets. Well, how do you make expected move stop growing while also increasing the expected move? So in the next video, I'm going to demonstrate using probably something else. I think we'll use Google because when it was taught to me, it was taught by looking at Google. I'm going to go in and demonstrate to you how expected move actually goes down and contracts. It gets smaller even when the implied volatility is going up, which is completely opposite of what is supposed to happen. Normally, when the implied volatility goes up, so does the range of the expected move, but not for earnings. It is proof that this implied volatility for earnings is a second-tiered Greek. It's not a real volatility. And one thing that you absolutely do not want to do is to sell a credit spread. You don't want to sell a credit spread believing that, oh, we've got a high volatility right now. This is a good time to sell a credit spread. That is not true. Okay, now if you're doing an earnings trade and you're just trying to sell that volatility like we do with iron condors, okay, I get that. There's a purpose to it, and you do it literally the day before or the morning of the earnings announcement, right? I get the trade. I understand. But look at Campbell's Soup back here in April, and it was going to report in May, and it was high compared to where it was. You could have been thinking, oh, hey, we're 1 month away from earnings. We've got a high implied volatility. I'm going to go sell credit spreads because these options are, quote, rich in implied volatility, and they're a good thing to trade. That's a bad idea. The reason why it's a bad idea is because you're stuck in that trade. It won't decay correctly. Typically, we sell a credit spread. We'll just say we sell the spread for $1. And if we wanted to buy it back, we would try to buy it back, say around 50% profit. And that would equal around 50 cents. Right? So we would put in our buy order to buy that back at around 50 cents. And in a regular credit spread that is built for 21 days, you might be stuck in that trade 10, 14 days. And you're done. You hit your target and you can move on. With a trade like this, if you was to put on one of those credit spreads, believing that it's got a high implied volatility and that the decay in the trade will kick in and do its job and you'll be able to get out of it, it won't work. The decay gets shunted as we come closer into earnings, and that darn thing doesn't lose its value. You're stuck in it almost into the day of expiration. Now, it will decay. Don't get me wrong. On the Friday of expiration, at some point during the day, it will collapse all of that value, and you will be able to get out of it as long as it wasn't a losing trade, right? As long as price hadn't broke your strikes and done anything like that. If we had put on a bearish credit spread here, when we got to earnings, we would be in a winning trade because price would still be below our position. So on the day of expiration, that trade finally would be profitable. But you're trapped. You're stuck in it because it's not decaying correctly. You have to be able to understand this logic, or at the very least, be able to just recognize that doing a credit spread using options that have a quote high volatility for earnings is a bad idea. Now, on the other hand, I was talking about earnings iron condors. An iron condor is two credit spreads. And on the day before earnings or the morning of earnings, you could put on the iron condor, look to take the the volatility crush, and then buy the trade back. That's something that we do frequently. There's nothing wrong with that. It's taking a 1 day trade. You're literally not even in it for 24 hours and you get right back out again. You're taking the accumulated sum of all of that shunted Greeks and waiting for it to collapse after the earnings are released. That's cool. And you can do that with a credit spread and not just the iron condor. The reason that people typically take the iron condor is if you only do one side of the credit spread or one side of the iron and it goes against you, well, you're going to be in a losing trade. But if you do the iron condor, you can get twice as much credit for the same trade. You're expecting price to get volatile for earnings and then settle back down again. And if that's the plan, that tends to work way more than it loses, and it's a good trade. All right, so guys, in the next video, I am going to demonstrate what that looks like with the shunting of volatility, and I'm going to prove that expected move actually shrinks even though the implied volatility is increasing when we're coming into earnings. And prove that the implied volatility for earnings isn't a real implied volatility. It's a second tiered Greek. It's not real. We can't use it the same way that we do with any other implied volatility. And I look forward to seeing you there.